Welcome to the Market Mosaic, where every week we are breaking down the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to formulate a view of where the market could be headed. And we have a lot to contend with, events happening over the past week, especially on the side of monetary policy and developments with the several developments with the U.S. central bank, and those events are having a spillover effect on the capital markets, and it's sparking historic volatility in precious metals. So we had the Federal Reserve wrapping up their most recent rate setting meeting. The Fed electing to keep rates steady for the first time since their meeting in July. The chart on here just shows you where the current level of the Fed funds rate is at. This is the white line on here, holding rate steady, the upper end of the range at 3.75%. So that stays the same. And the blue line on here is the Fed's balance sheet assets. And the one thing to note in the Fed's balance sheet is that the Fed ended its program of quantitative tightening back in December, whereby it was letting Treasury securities held on the balance sheet mature without reinvesting the proceeds. So that had the effect of shrinking the balance sheet that corresponds to the scale on the left over here. And this ends up being nearly $9 trillion on the balance sheet at the peak. And you can see that quantitative tightening, the effect of that, significantly reducing the size of the Fed's balance sheet, though maybe not as much when you look at the context of where we've been over the last couple of decades. But you'll notice that recently the Fed's restarted QE, quantitative easing. You see this little blip on here, the slight uptick in the Fed's balance sheet. And it's because the Fed is trying to address some funding constraints, some liquidity concerns in short-term funding markets. And they won't call this QE, but it is asset purchases they're conducting that is increasing the Fed's balance sheet. Now, in the Fed meeting, they called it a hawkish pause. So they paused rate cuts, but they called it a hawkish pause because there was a hawkish tone to it. And more specifically, in the meeting statement, the Fed eased concerns over the health of the labor market, but they also described economic activity as expanding at a solid pace. Now, that was the meeting statement. In his press conference, Fed Chair Jerome Powell commented that the economy has once again surprised us with its strength. And one thing that's been notable over the past year is that consumer sentiment surveys have been very negative. But what Powell said is that the consumer is filling out surveys that sound really negative, and then they're spending anyway. So it speaks to, again, the ongoing strength and resiliency that we've seen in the economy. But that was not the only development last week with the Fed. Investors were also confronted with news of the next Fed chairman. So Powell's term is scheduled to end in May, and President Trump announced that he will nominate Kevin Warsh to serve as the next Fed chair. Now, this is notable because Warsh, a couple things here. One, Warsh is a veteran of the Fed. He served on the board of governors already from 2006 through 2011. So that captured the period going into and coming out of 2008's financial crisis. But most notably, we're showing this chart on the Fed's balance sheet. Warsh has criticized the Fed's asset purchase and balance sheet expansion at a time when, again, these purchases are kicking in here once again. And so the concern with the market is that you have maybe a hawkish Fed chair who is less accommodative to the capital markets, and that's sparking some spill-on effects. But nonetheless, Trump's not going to put someone in the Fed who is opposed to keeping interest rates at these levels. Trump has been very adamant that rates need to come down. Trump's been very adamant that rates need to come down from where they're at, and this chart helps explain why there is such an intense focus on lowering interest rates right now. And it is because as federal debt levels have swelled, the interest expense on U.S. debt outstanding is just absolutely exploding higher. So what this chart on here shows is it shows the green line is the interest expense on U.S. debt corresponding to scale over here. So this is the absolute level. The blue line is that interest expense relative to GDP. And no matter how you want to measure it, you can see both lines have just absolutely exploded higher since about 2022. This was coming out of the pandemic where there's a lot of borrowing to fund economic stimulus, and the deficits have not stopped. We have the one big beautiful bill coming to effect this year. There's still projected to be up to a $2 trillion based on current forecast deficit this year. So these figures are not slowing by any stretch. And as these interest expense payments are surging higher, that's where, a big part of the the focus is on lowering rates because a lot of it's directed toward wanting to bring down borrowing rates to assist things like the housing market. But in the back, you have this lurking in the background too, that this interest expense on government debt has just been surging higher. And so that's, whoever comes in as the next Fed chair is widely anticipated to keep cutting interest rates. But there have been a number of knock-on effects due to all this news around the Fed last week. So we had the dollar reversing off a key level, gold and silver prices just absolutely plummeting. So let's look at the why precious metals and stocks could be vulnerable to what's happening this past week with monetary policy. And I also want to look at why the Fed's job might be getting a lot tougher given some developments we've seen on the inflation front. So a key measure of the currency debasement trade and a catalyst behind the move that you've seen in precious metals, that is testing a key support level, and that is what the U.S. dollar index. So the U.S. dollar index, it measures the dollar against a basket of other currencies, including, you got the euro, the yen, the pound, and others. And DXY, so if I took this back a little further, you'd see the dollar had a pretty major peak in late 2022, and the downside in the dollars really accelerated last year. You're going to see this drop from the start of 2025 through about the middle of the year before finally stabilizing. But ended up the dollar index, this DXY index, had the worst year in nearly a decade. And at the end of January of this year, you see another drop starting to happen. So we had DXY starting to pull back again, and it tested and very briefly broke through this key level at 96. You can see this was a low tested 2 times back in 2025. Well, last week, we came right back to that level. You can see with that bar, we undercut it, but then quickly reversed higher. So this is a failed breakdown of the dollar. And so why is this important? It's because a declining dollar has been a big driver behind the gains in precious metals. And this failed breakdown that you see last week with follow through to the upside after the Warsh announcement, this was likely a big catalyst in the sharp pullback that you saw in gold and silver. So gold and silver, I mean, you saw spectacular gains in 2025, and to start 2026, we had more to go in the rally, and that brought us to record highs. So gold prices topped out just over $5,500 per ounce. Silver saw $120 per ounce, but that parabolic move hit a wall last week. Following, you had a couple things. You had the U.S. dollar index reversing higher. That's bearish for precious metals. And you had news of Kevin Warsh being that Fed nomination for the next Fed chair, which is stoking some hawkish fears over monetary policy. So the combination of those things was a big driver in the pullback in precious metals. Now, gold dropped nearly 10% in a single day. It's its worst daily. So this shows the daily return in gold prices. You can see down nearly 10% was gold's worst day since 1983. And silver, at one point during the day, silver on Friday, silver was down over 30%. But look, conditions, they were ripe to see a reversal because gold and silver were stretched significantly above key moving averages. And so while a lot's going to be made of this single day drop, it is worth noting, if you pull up a chart of gold and silver, you will see that they remain, even with this drop, they remain in primary uptrends, and they are still trading above intermediate term moving averages like the 50-day moving average. So the surge in precious metals, we've had a big rally in base metals too, like copper. We're seeing record highs. We're seeing other commodities join that rally. There's been a lot of upside recently in oil and also specifically in natural gas. And that is helping to drive a key breakout in broader commodity indexes. But that has massive implications for the inflation outlook. And I think this is a really overlooked warning signal hitting the market recently. And that is the most recent producer price index, a PPI inflation report, was reported at a year-over-year increase of 3% in December. Now, the core figure that strips out food and energy prices rose by 3.3%. That was a lot higher than expected, than economists were expected. They were calling for an increase of 2.9%. So 3.3% versus 2.9%. So core PPI inflation is the blue line on here. It tends to lead changes in consumer inflation. So the green line is core CPI. And you can see, go back to the last inflation cycle, you see PPI starting to meaningfully inflect higher about a year ahead of CPI. You see PPI peak out in early 2022, about 6 months or so ahead of the peak in CPI. And we had the PPI, make the low in late 2023, early 2024, and has been, grinding way higher ever since. And so this most recent tick higher, keep a close eye on this blue line. If we continue to accelerate and push above this high made in 2025, that's a big warning signal for consumer inflation as we get later into 2026. All right, so precious metals grabbing the headlines. You definitely had a lot of bullishness. You had a lot of investor exuberance. I believe those things played a key role in the magnitude of the decline. But the one thing you want to keep an eye on is similar conditions are forming across measures of sentiment in the stock market. So B of A compiles a monthly fund manager survey. They go out and they ask about the views of 400 institutional investors. So institutions are going to be things like mutual funds and hedge funds. And it's worth watching for the extremes. So you want to watch for extreme crowding, whether it's bullish or bearish, because that's historically been a reliable contrarian signal. So what the chart on here shows is it plots a percentile rank of these fund managers and what they expect in terms of growth, as well as their stock market exposure and their cash level. If they're holding high levels of cash because they're fearful, or low levels of cash and a high market allocation because they're bullish. And so you can see right now we are getting toward a bullish extreme. This goes all the way back to 2000, and you can see some of these prior peaks. And this because we get up to these prior peaks didn't necessarily trigger some massive bear market event, but it did signal that some of the easier times in the market were behind us at that point. And this works on the other side as well. Look at some of these really low readings in this sentiment indicator. So here was the sell-off in the trade war in 2025. This SVB, this was early 2023 when you had the bank crisis in full swing. So these, when you get down to these levels, this can be a contrarian indicator to get in. But right now we're starting to see, peak bullishness in this fund manager survey. And so that's just something to be aware of, something to be cautious about as we get into 2026. All right, so we see that fund manager sentiment is pushing near bullish extremes. Now, I think it's, as a contrarian indicator, that means you should be cautious. Well, I think it's really interesting alongside that to track the action in Bitcoin. So Bitcoin could be sitting in a warning on the outlook for financial market liquidity. It's because historically, at least, Bitcoin's performance, the longer term performance, has been highly correlated with global M2 money supply. So Bitcoin can kind of serve as this barometer for central bank monetary policy and what it means for liquidity conditions. So Bitcoin, we had this peak back in early October. It's kind of this false breakout above the $120,000 level. So it got to around 125,000 and then reversed very quickly, and has struggled ever since. So losing the 50-day moving average, coming down here in November to test the levels seen back during the trade war. We tried to rally off that level, got above the 50-day, but that was a failed move higher. Now we're pulling back once again. Now there's some key developments over the weekend to keep an eye on. So, after testing this low again, Bitcoin is losing some key support at this 80,000 level. So you can see this dashed line. We're starting to move through that support level. And if we sustain that move, if it completes this pattern, this could be a bearish head and shoulders pattern. So if you look at left shoulder, the head, and formation of the right shoulder, usually you like to see some symmetry in the shoulders, and this one did not develop the same way that the left shoulder did. But nonetheless, if we do take out this level, what this is really telling you is that the primary trend in Bitcoin, now you have a lower high and a lower low in place. And so if we see this continued breakdown in Bitcoin, that could be sending a warning on what financial market liquidity is going to look like later in the year. All right, we do have some economic events coming up this week. Most notably is the ISM PMI survey. So just a nice coincident indicator of business activity. But really what you want to keep an eye on is earnings season. We are in the thick of earnings season, and this chart on here from Earnings Whispers plots out some of the notable reports that are coming up. And one thing you want to keep an eye on with the market right here is follow stocks that are in some way, shape, or form leveraged to the AI theme. A lot of the Mag 7, a lot of the stocks leveraged to the AI trade, like Palantir too. They have been Mag 7. They have been lagging over the last several months now, struggling to make new highs as the S&P 500 has been hovering near the highs. I mean, it's been a good environment for breadth, but given the weight of these stocks in the S&P 500, we need to closely track these names are responding to earnings releases as that tips developments on the AI front. So, you want to keep an eye on names like AMD, Advanced Micro Devices, ARM. You want to keep an eye on Google, Amazon, some of these AI hyperscalers. So we're going to have a very busy week for earnings, and you want to keep an eye on how stocks, and we have Palantir as well. You want to keep an eye on how names leverage the AI trade are responding to these AI earnings releases. So we know we got AMD earnings coming up. Advanced Micro Devices, definitely a chart setup you want to keep an eye on. So what I like about this chart was if I were to extend this back further, you could see this breakout over 200. That was a move out of a very lengthy basing pattern. So that's kind of your primary base breakout. So we moved it off of that, ran up to close to the 270 level, and it started a new consolidation pattern. So we're testing that 200 level as support multiple times, which is held. And recently, we've rallied back toward the prior high. That's gotten the MACD a little extended. So what does that tell us? It means to be on the lookout for some mean reversion, which we've seen. We've seen a pullback. If we get a couple more days of pullback that resets this MACD, this could be a really compelling setup to watch heading into earnings, and it gives you a make or break line to watch here for putting on a trade. I don't feel compelled to do anything with this name. It's trading in this pattern ahead of earnings, and then once we get that earnings release, if the investors are disappointed and it pulls back, then we're doing nothing. Turn around and we break out. I mean, that can be a signal that AMD. We've seen a lot of semiconductor names benefiting on the back of the AI trade, and if we get a breakout over this 270 area, AMD could be the next name to run. All right.